Wall Street is currently going through a bizarre disconnect. The biggest tech names on the planet are breaking revenue records, and yet the moment they announce those numbers, investors are scrambling for the exits. Look at Alphabet. They just posted $120 billion in revenue, including an 82% surge in their cloud business. That is massive growth, but the market didn't cheer. The stock instantly dropped almost 8%. And it isn't an isolated incident. Oracle recently crashed 36%, defying the usual logic where high earnings automatically equal a rising stock price. The panic comes down to a critical accounting metric called free cash flow. That is the operating cash generated by a company's core business, minus the cash they spend on capital investments. Right now, companies are pouring a massive torrent of that cash into building AI infrastructure. This chart shows the projected capital expenditures for hyperscalers like Google, Meta, Amazon, and Microsoft. Over the next year, they are expected to spend a staggering $900 billion combined, a massive spike compared to their flat historical spending. That heavy investment slashes into their core operating cash. Even with record revenues coming in, spending at this scale pushes near-term free cash flow deep into negative territory. Investors are no longer willing to bankroll promise alone. The market has pivoted to demanding immediate, tangible cash flow. If the AI spending doesn't translate to profit right now, the market is walking away. But that $900 billion has to go somewhere. The cash flowing out of the software giants is landing squarely in the laps of the physical manufacturers building the underlying AI supply chain. We are talking about the infrastructure leaders, companies like Nvidia, Broadcom, and Supermicro, who are manufacturing the chips, memory, and servers needed to run these data centers. These hardware companies are sitting on massive backlog revenue orders. They boast gross margins that double market forecasts, insulating them from the immediate day-to-day volatility of the software side. The most strategic AI play right now skips the software creators entirely. It focuses on the hardware manufacturers who are cashing those massive checks from the hyperscalers. Beyond tech, the broader global environment is shifting. Sticky inflation and a 15% pop in the price of oil are creating a perfect storm that is forcing capital out of high-flying sectors entirely. This line graph compares the trajectory of a rapidly ascending growth ETF against a flatlining value ETF. Over the last 4 years, high-growth names crushed value companies, outperforming them by 77%. But as interest rates rise, this extreme gap is rapidly reversing. Capital is stampeding out of shaky growth names and into cash flow stable value companies, like banks trading at steep discounts to their actual earnings. One of the safest destinations for that capital is midstream energy. These companies own the physical pipelines, processing, and storage infrastructure for oil and gas. They act like toll booths, collecting a fee on every single barrel moved, completely regardless of the commodity's underlying price. Because of complex tax and accounting rules, you evaluate these pipeline companies using a metric called distributable cash flow, or DCF, rather than traditional price-to-earnings ratios. It reveals the true amount of cash they can hand back to investors. In a shaky market, heavily discounted value stocks and pipeline companies offer guaranteed dividend cash payments. They provide the reliable income investors need to weather economic turbulence. Some capital is finding a middle ground. For investors who refuse to abandon growth, but require companies with proven, reliable profit margins, there are specific sectors offering both. Cybersecurity is a primary destination. Companies like Fortinet are combining steady 16% revenue growth with undeniable sector-leading profitability. They are generating real earnings right now, not just promising them a decade from now. You also see this in disruptive fintech. SoFi Technologies is growing its revenue by 30%. Yet it trades at an extreme historical discount relative to its own price-to-book value, a standard measure used to evaluate bank stocks. Taking a contrarian stance right now means moving against the herd. While the market panic sells anything with a tech label, the opportunity lies in picking up these profitable, growing companies that are being ignored and undervalued. The ultimate driver of this entire capital rotation sits with the Federal Reserve and the looming threat of higher interest rates designed to cool the economy. Even though corporate profits in the S&P 500 are up 38%, the Personal Consumption Expenditures Index, the inflation measure the Fed watches most closely, is hovering at 3.7%. That sticky inflation guarantees violent market swings for the next 6 months. The strategy of buying every dip and expecting an immediate bounce has hit a wall. In this environment, survival requires navigating through a gauntlet of economic pressures and carefully shifting capital into sectors with proven stability. We are already seeing hedge funds and legacy portfolio managers capitulate. After years of underperformance, massive fund managers are rapidly overturning their holdings in response to these exact pressures. To protect your portfolio, track the free cash flow. Step away from the AI software hype, buy the physical hardware supply chain cashing the checks, and anchor your money in cash-generating value stocks.